Welcome back to Wealthway, where we explore the fascinating world of investing. Today, we're going to talk about a concept that can turn your investments into a steady stream of monthly income, just like a snowball rolling down a hill. We'll delve into the dividend snowball effect, discuss two powerful investment strategies, and show you how you can potentially earn $5,000 a month from your ideal portfolio. Buckle up, it's going to be an exciting ride. Now, let's dive deeper into the enchanting concept of the dividend snowball effect, where your investment portfolio takes on a life of its own, much like a snowball rolling down a hill, gaining size and speed with every turn. However, in this financial analogy, instead of snow, your snowball consists of the ever-increasing dividend payments from the carefully chosen stocks in your portfolio. As it rolls forward, it doesn't just accumulate snowflakes. It amasses dividends, and with each revolution, it compounds its growth exponentially. This notion brings to mind the wisdom of the legendary investor Warren Buffett, who once imparted, "Someone is enjoying the benefits today because someone planted a tree a long time ago." In the world of investments, it's about planting the seeds of wealth today and patiently tending to their growth over time. Investing in dividend-paying companies and allowing your dividends to not just grow, but compound over the years is akin to nurturing that tree. It demands patience, but the potential rewards are nothing short of remarkable. To truly appreciate the power of dividend investing and the dividend snowball effect, let's explore two illustrative strategies set over a 25-year horizon. These strategies revolve around an exemplary company named ABV, renowned for its consistent dividend growth. In the first strategy, we have John, who makes a single substantial investment of $1,000 in ABV stock. Fast forward 25 years, and this investment, with reinvested dividends, blossoms into an astonishing $29,715. However, had John not chosen to reinvest his dividends, the portfolio would merely be worth $4,632. This stark contrast of $25,083 underscores the profound impact of reinvesting dividends. It allows you to accumulate more shares, which in turn leads to higher future payouts. Now, let's take a moment to consider a slightly different scenario. Imagine John invests a more substantial sum of $10,000 upfront as a one-time investment. After 25 years, this investment would be valued at an impressive $297,153.96, paying out an annual dividend of $37,698. That's approximately $3,140 per month, a consistent flow of passive income that can significantly enhance your financial stability. This vividly illustrates how even a modest initial investment can grow into a substantial sum over time, especially when coupled with a diligent practice of reinvesting dividends. The potential for astounding growth in your investment portfolio is a testament to the enduring power of the dividend snowball effect. But what if you're not in a position to make a large initial investment? Enter the strategic approach of investing $1,000 initially and adding $200 every month. Over 25 years, with a continuous reinvestment of dividends, your investment would balloon to a remarkable $535,610. This investment would then provide an annual dividend income of $67,785, which translates to approximately $5,650 per month. The true magic of this approach lies in the compounding effect, which gains strength and momentum with each passing month, showcasing how small, consistent investments can lead to significant financial success in the long run. So, Whether you have a lump sum to invest or prefer to start small and build your way up, the Dividend Snowball Effect offers a path to financial prosperity through the accumulation of reinvestment of dividends. It's a testament to the beauty of long-term investing and patience in nurturing your financial future. Now that you have a solid grasp of the remarkable potential that the Dividend Snowball Effect holds, the next logical step is to understand where to invest your hard-earned money to initiate this financial snowball. Let's start with dividend aristocrats, a group of companies that have demonstrated their reliability by consistently increasing dividends for a minimum of 25 years. These firms are typically large, well-established entities with a solid track record of dividend growth. Consider names like Coca-Cola, Procter & Gamble, Johnson & Johnson, and McDonald's. They have stood the test of time and have consistently rewarded their investors with growing dividends. Another avenue to explore is investing in exchange-traded funds, or ETFs, that are specifically designed to focus on dividend-paying stocks. These ETFs offer diversification by pooling together a collection of dividend-yielding companies. Here are 3 top-performing ETFs in this category. 1. SPDR S&P Dividend ETF. This ETF currently boasts a yield of 2.91% and has averaged a solid return of 10.23% over the past decade. It provides exposure to a broad range of dividend-paying companies, offering stability and income potential. 2. Vanguard High Dividend Yield ETF. With a current yield of 2.99%, this ETF has delivered an average return of 10.45% over the past decade. Vanguard is known for its low-cost investment options, making this ETF an attractive choice for long-term investors. 3. Schwab US Dividend Equity ETF. If you're seeking higher yield potential, consider the Schwab US Dividend Equity ETF, offering a current yield of 3.69%. What sets this ETF apart is its impressive average return of 14.61% over the past 10 years. It's designed for investors looking to maximize their income potential while benefiting from strong capital appreciation. Additionally, real estate investment trusts, or REITs, present another compelling investment option. REITs specialize in investing in income-generating real estate properties, such as office buildings, retail spaces, and residential complexes. By law, REITs are required to distribute at least 90% of their income as dividends to shareholders. Some notable REITs in the market include Kimco Realty Corp., Brandywine Realty Trust, and Brookfield Property REIT. These trusts can provide a steady stream of dividends while offering exposure to the real estate market. Now, let's delve into the potential returns from constructing an ideal portfolio with carefully selected investments. We'll consider 3 top-performing assets for our portfolio. McDonald's with an impressive 8.39% return, Schwab US Dividend Equity ETF with a stellar 14.61% return, and Brookfield Property REIT, which boasts a solid 7.54% return. Under Strategy 1, One-Time Investment, your initial $1,000 investment blossoms into an impressive $12,607, generating an annual dividend income of $1,215. This steady income stream can provide financial stability and enhance your overall financial well-being. With Strategy 2, monthly $200 investment, your investment portfolio experiences exponential growth, ballooning to an impressive $288,575. This translates into an annual dividend income of approximately $27,711, equivalent to an enticing $2,310 per month. Such a monthly income can significantly enhance your financial security and provide peace of mind during your retirement years. However, the true power of these strategies becomes evident when you extend your investment horizon to 30 or 35 years. Over this extended time frame, the effects of compounding and reinvestment are truly remarkable. Your portfolio value and annual dividend income skyrocket, showcasing the potential for long-term financial success and independence. Thanks for joining us on this enlightening journey into the world of the Dividend Snowball Effect and intelligent investment strategies. If you found this video valuable, please consider giving it a thumbs up, subscribing to our channel, and hitting the notification bell. Stay tuned for more insightful financial content as your journey to a financially secure future begins today. Happy investing!